everyone's tongue, I think, and with good reason, with very good reason. Again, we fell a very long way. It's similar to what I was saying about oil, that relinquishing in demand. You suddenly had a situation where people start to get worried in the summer about potentially what inflation is going to look like on the global stage, particularly in the US, because the US normally forms a status quo for the rest of the world. And that fall, which you saw, took you from 4,600 all the way to 4,120. Okay, 408 points, bang, straight down. Now, the interesting thing here, and the reason why I like it short now, is because if you take where we were up here, just over 4,620, let's say, and the point down here, okay, it's actually more like 500 points. Now, the interesting thing is the peak came on the 27th of July, and it takes until October the 30th to fall. So it takes 3 months to do that. But if you look where we are now, okay, it has taken around or just under a month to erase all of that. So that says something, doesn't it? Okay. Now, when you have these really, really sharp up moves, often people suddenly liquidate their orders and they take the value of their trade to the long side because they've had this sudden increase in value. Now, if it's gone up 3 times faster than it fell, okay, it tells you a lot, doesn't it? Because this was a slow trickle. People were slowly getting fearful, and now they're not. Now they're suddenly getting very, very unfearful and rather greedy. But what happens after these moves? Okay, well, if you've gone up from 4,120 to 4,560, okay, you're almost as big as the previous swing. You've almost got 100% fib. This is probably about 88.6 or so, okay, which is a strong fib level. After this, you tend to get falls that take you back to your key moving averages. The reason why I use key moving averages is because the price always inevitably, in basically nearly all cases, apart from things like, Zimbabwe dollars or whatever, or some kind of exotic currency where you've got an extremely unstable economy, the price may eventually come back to MAs, but in 99% of cases, that is what happens. Especially, I would say in 100% of cases in well-traded things, major FX pairs, major indices, things like that, because they're stable. They set the stage for everyone else. So in that knowledge, you would find that you're about 120 points away from that. The reason why you're stalling is because it hasn't got to the point where the market sentiment has come out or market news and it says, you know what, there's some reason as to why the market should fall. At that point, people will start to sell more. But as you get higher and higher and you get near a 100% retracement, okay, the chances of people taking their money increase dramatically because they are getting more value on their trade. As the market goes up and up and up, the value of their trade or the profit they've got rises. Okay? Now, a minute ago, I said that took 3 months to fall. And when it did rise, it's gone up 10% in less than a month. Okay? Now, if you look, for example, and again, it comes down to this simple fact. If you don't believe me, go and look at charts, okay? Because you don't have to believe me. It's there. Look over here, for example. Okay? Let's take a month of data. So you started rising, let's say, over here, 19th of July. Let me just zoom in on it. 19th of July, all the way to the 16th of August. I remember that when it happened. Or you could even say the 16th all the way up. So in 1 month, and again, look, it comes to your 200 MA, absolutely no coincidence. You've come back to a high moving average on a really rash move. That's what happens. But in a month, you've come up from, this point of 3786 to 4329. Okay, so that's a rather long way, isn't it? Let's say 3800 to just over 4300, 500 plus points from trough to peak. Okay, in about a month. What happens after that? So at this point, everyone would have been raving, saying, wow, this is great. And again, those people who I described before would have said, Will, why are you shorting? You should be buying. The stock market's great. Invest. And suddenly, the comments go quiet. People stop telling me to buy. And the price comes down. And it doesn't just come down, it comes down dramatically. Okay, so again, if you don't believe me that markets fall after rises, luckily for you, you don't have to. Okay, again, all the gains are erased within a. That is very fast. So just take note of that. It can easily occur, and it will occur. Okay, and it happens time and time again. Look at this. Let's go even further. I mean, you can do this till the cows come home. All right, and if you don't know what that means, it's mostly an English saying. I'll let you Google it. Means it takes ages. This was a 2-week move, 15th of March. All right, well, 15th of March, 4130, 4630. 500 points in 2 weeks. 2 weeks, half the time. What happens after that? Oh, it goes all the way down. And funnily enough as well, what happens is it stalls before it goes down because there's a lot of indecision. That is very frequent of things like this. You get a very large move and then you pause before it comes down. And you can see what's happening, can't you? If I zoom out, can you see that? Again, funnily enough, it just happens to be a downtrend. Okay? So markets move in trends naturally and they fall after very harsh rises. If it does appear that perhaps things aren't as good as people thought, you may find the same thing here. Like that. It was stretched all the way down, but you would need another low there. But the salient fact is that you'll come up and up and up and up, and really it's better to be selling than buying because people are going to sell, especially the larger money in the market. They're going to say, wow, we've come up a really long way in a month. I think we'd rather not sit on our profits. We'd rather take them and reduce the market price. And of course, scale in as you fall to key support and key moving averages. So that's your SPX. I'm just going to cover the US100 in the same light mostly. But again, what have you got? Well, you've got a big runoff from your key moving averages, haven't you? Step 1, you're well off your MAs and you're well off support. Step 2, you've got this dawdling side to side. It's not moving a lot. Okay. Now with this, you have fully erased the move. Okay, you're above a 100% retracement. It has gone beyond where it was. Okay, so again, look how long that took. 19th of July to 26th of October. It's over 3 months. All right. And you're now stalling. You're well off your key MAs. And again, like I said, if you don't believe me, it happens. Okay. If it takes a very long time, it sometimes stumbles for a while. But if you look previously, you've got it on US markets. US markets have grown in value greatly, okay, since you had COVID, because you had your pullback, and now the market is well above where it was pre-COVID. Such is the nature of the growing industry. So it's helpful as well, therefore, to limit your sizes. I wouldn't go crazy if you are shorting any US market. Okay, I wouldn't be shocked if US markets get above the previous high. But like I said, all you can do is short into these markets. Just bear in mind, you've had an enormous rally. You've had to pull back considerably. It's maintained its strength. Okay, if it does form a long-term uptrend, I wouldn't be shocked. If it falls here, I wouldn't be shocked. But it doesn't matter You don't have to specifically know what's going to happen in any market. You don't need to do that. Nobody knows what's going to happen in any market. All you can do is short the market value on basic principles, basic market rules playing out because you've seen them so many times before. Like I said, if you don't believe me, all you have to do is just go and have a look back. It's happened many times before. So my bias on the SPX and NASDAQ US100 is short. As I said, underneath is my training. Don't forget to grab it.